Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone, it's Liam Garman here, editor of Smart Property Investment, back today with another episode of the Smart Property Investment Show. And I am joined by a gentleman all the way from Brisbane, back by popular demand. Now, the theme of today's podcast is something that everyone is thinking about. Every smart investor that listens to this podcast, I'm sure over the last few weeks, the idea has popped into their mind, in particular, the move to higher yielding assets and what economic and what the global uncertainty means for yields, means for cash flows. Already we've seen there being one interest rate rise on this cycle, two if you include last year's, with potentially more on the horizons. I know a lot of smart cookies out there in the world of economics and finance predict that it might not be over. So a lot of our negatively geared listeners might be thinking, well, what's this going to do for our bottom line? Even if you're positively geared, will that start dipping negative? If you're looking to buy a home, are you going to be able to take and accept lower yields, or should you be moving into higher yielding assets like units and townhouses? But today I am joined by a gentleman who is far smarter than me on this, who's going to take us through this journey, Steve Ash from Property Strats. Back to the podcast by popular demand, because you and I had a pretty bumper recording session last year. It was back-to-back on SBI. How are you going?
Yeah, no, I'm good. And I think you're giving me a big head.
No, well, you know,
you're not smarter than you.
I mean, you kind of, it is funny because we agreed to record today, and you and I came up with the same things to talk about. You know, it's always good because I kind of, different guests we have on this podcast have different niches, you know, different specialties, and we kind of discuss, you know, what our listeners want to hear more of, see more of, and what you'd like to discuss. And we kind of came with the exact idea, which is a lot of economic uncertainty. Cash flow is the name of the game at the moment.
Yeah, it's a bit Twilight Zone. It was quite bizarre. So I was kind of thinking, okay, coming on, let's think about some sort of topics over the weekend, sort of cash flow. I think the easiest way to sort of do it is get a feel on what sort of clients are seeing, what questions that we're getting from the company, etc., and what I'm seeing out there, and then say, I thought cash flow. Let's come up with a sort of segment on that. And you've come up with the same thing. So I think that's pretty sort of appropriate. But it is a big thing at the moment, and I think the intro that you gave for the show there was gold. Like, you know, it is uncertain. Very uncertain times at the moment. 2 rate rises. We've got some of the government policies kind of looking a little bit sort of hawkish, really, for sort of property prices. Like, you know, the Albanese government talking about the CGT discount sort of changing. Then you're potentially talking about sort of like removing negative gearing onto properties. So any way people look, like, it's kind of like, oh God, like it's maybe it's not the right time to do it. Like, so cash flow is a bit of a part of that. And so I actually saw a headline on news.com the other day, not like frequent news.com very often, but it was like, I think it was George Panos talking about, you know, sort of negative sort of connotations for property. And so if someone's looking there and they want to get ahead and they want to sort of build wealth, like, there's negative news everywhere at the moment. And of course, obviously got the situation in the Middle East. So if anything, people are getting knocked, and then people are kind of coming to, you know, maybe a little bit concerned, looking at kind of what they're picking up in Brisbane or Perth, as we were talking about off air, but then also Melbourne, where we see a lot of value in, and then looking at those yields and thinking, oh, blind, these are kind of like unpredictable times. My cash flow is going to be X amount. So, like, how do I get more neutrally geared investments given where the cash rate is? And it's very topical at the moment. People want to keep building their wealth, but they want to, and they've got one eye on sort of like what's coming up. So I think, you know, you're obviously feeding it as well in what you're seeing, you know, with the Momentum Media and then probably the guests you speak to, but we're definitely seeing it on the street with clients. So very, very appropriate topic to talk about.
Oh, without a doubt. And there is a lot to unpack there. At the end of the day, the way that I'm looking at it is there is an element that we have to go back to the basics as an industry, you know, as investors and buyers, agents, and the broader real estate industry. You have to go back to the basics. You know, I only started investing after that 2020 kind of COVID boom, right? All I've known in the world of investing over the last half decade is the 20% annual return sugar rushes.
Yes.
And I think too much of the industry and too many new entrants to the industry are like, I expect 15% annual returns and it's going to go on forever. again, what we were talking about off air, especially with a lot of people who are falling for that herding behavior. We don't have to name postcodes, but we all see the postcodes where it's like, Darren from the family barbecue, he's made 400 grand in 2 years. Now I'm going to buy into it. Well, that asset, that area's already had its growth. You're probably the last mover. You're the last entrant into the market.
Yeah.
You're probably quite leveraged to do it as well. These are the people who will be feeling it quite acutely. But as an industry, I think we do have to go to the basics, which is, hey, realize that this is a long-term play. Phil and I always talk about when he started his property investing journey and he wouldn't go $1,000 above his maximum, which is funny now. People look at it as like, well, if it's in a growth area and the market's going to do the heavy lifting for you and it's naturally going to grow, what's $1,000? But that's what it used to be. And I think we got to go back to that and acknowledge that there is a cost of doing business. If there is a 25 basis point rise, it costs you $100 at the end of the month for that asset. That's the cost of doing business.
Yeah, no. I think it's a really good call out. And obviously, Phil would have started his portfolio sort of. I remember picking it up in the magazine print when I was a kind of fledgling investor, reading how he's setting up. I think it was the portfolio via the SPI sort of show. But the rates there were pretty. Roughly 7.5% back in the day. So you had to really watch what you were doing. There was quite a bit of stagnant growth in various markets at that particular time as well. And I think that's a really good point you make. All anyone's really known since COVID and maybe just a little bit before then is 20% sort of growth. You just kind of cycle. We go from Brizzy to Perth and then maybe regional, and everyone's kind of like making money for jam. And so like it can't go on forever. To your point, the stock market, for example, has been very bullish over the last, since the debt crisis, I'd say. So the last 10, 12 years have been very, very good. But we know that this party doesn't go on forever. So sometimes maybe it's a time to think about being a little bit more defensive and looking at kind of like those assets that are kind of good inflation hedges of what's going on at the moment, and just being a bit simpler, going back, not overpaying, to your point about the $1,000, looking at the deal economics and really kind of like thinking really strongly about the next purchase, how that's going to be impactful, because it's simply not going to be a case where you're just going to you're going to put your money on the table and it's going to go out 100 grand in like 3 or 4 months. I think we're approaching more kind of different sort of times, but with that there's opportunity as well. So I think you called it out really good. And I don't think some of the pods I've talked through, I've talked about maybe a black swan event potentially around the corner. It's called Black Swan because we don't know what it's going to be, but we do, like COVID was a black swan. Maybe you could argue what's going on in the Middle East is, but I wouldn't say so because we know it's been bubbling for a while, but there's always something that potentially comes. When we've had years and years of such good times, then something usually does come to sort of knock it down. So you need to be protective. You can't just go, I think you were talking about the example of buying in Vic, for example, having that negative cash flow on a property. You can't just keep stacking those because you're going to run out of serviceability. And then there's a real risk to the family if there is a problem with the job situation, etc. So the pivot to maybe sort of cash flow, I think, is clearly at people's mind. And then they're kind of like, then the next problem then becomes is that I want a house. Like houses outperform units and townhouses in terms of capital growth. And historically that's been the case, but like it'd be great if we can get those houses at the 6%, 7% yields. Can't do that anymore. So we've now got to be a little bit smarter and look at kind of where we're at in the cycles.
I like your term, and I actually wrote it down, different times. We're moving into different times because for all of these macroeconomic, global on the one hand, but macroeconomic policies in Australia, I think that there will be postcodes. And this is how property's always worked in Australia, right? I think there will be some postcodes that could very well pare back. I also think that there are postcodes where you will continue to see quite substantial growth. So capital gains tax, I've been very clear on my opinions with capital gains tax, which is you're disincentivizing people from selling. So when 50% of property
100%.
Investors in Australia are positively geared, well, now they've really got no incentive to put stock on the market. It's like, well, it's already positively geared. Maybe it's chewed away a little bit with interest rates. If they still have a mortgage, some might not. But well, now it's already positively geared. Now I'm further disincentivized from putting it on the market. Hey, we don't have an inheritance tax in Australia. Down the generation it goes. I think there's going to be a lot of areas where you're now going to bake in a new floor. and there is going to be a new floor, and property prices might even increase in certain areas when you disincentivize investors in selling. And that's not going to be the case in all areas. So I do think there will be areas that might pare back a bit. Same with negative gearing. It's a cost of doing business. But broadly, do agree that there probably is a black swan event on the horizon. That's why you got to be smart with it. You got to go back to the basics. Now, you've mentioned a few times about looking for the alternatives. So to make a more defensive play in your portfolio, alternative assets. Well, and they're not alternative assets really, but they're just everyone always talks about the established home on a bit of land. What we're seeing now is some pretty bumper yields in the world of strata titled properties in units, in townhouses. This might be a good option for people to look towards as they're trying to buffet their their portfolio a bit.
Yeah, I think so. And I just kind of, I've talked a lot about sort of, if we look at kind of like the old sort of status quo and and how people have kind of grown portfolios before, you've really got two camps really. You've got the capital growth type camp where you kind of buy as close as you can, the best asset you can, maybe get 2 or 3 of them, maybe sell a couple down and you're retired or whatever. But the negative cash flow on that is quite significant, and it can become quite hard psychologically, obviously, to hold that. We're talking about uncertain times, so that makes it even doubly harder. And then you've got the others, the second group, which are the cash flow type investors. It's kind of largely the route I've gone, more kind of affordable housing, and then try to stack them on top of each other, build the portfolio as much as you can. And I think you can probably answer this question. I might put you on the spot, but the people you have in the hot seat here, my guess is that obviously there's going to be a lot of brokers and buyers agents who do come on the show, but obviously individual investors. My guess would be that the people who've hit the financial freedom have maybe outperformed the people in the second camp. Is that a fair sort of assumption, or?
I think it's people that acknowledge that the two camps exist. Yeah, of course, because so with the former, right, with the first camp, if you bought an asset in an area which wasn't going to experience substantial rental growth, and then you had those 13 consecutive rate rises, you would have done yourself a huge disservice.
Yes.
Sure, the market can do the heavy lifting for you, but you also have to be able to afford to hold it for that time to actually experience the growth. So I don't think anyone can make it just relying on the former.
No.
Yes, I think is my.
There needs to be a mix.
There has to be a mix, and there's always going to come a point, right? Like, I would say everyone in the guest seat says, you're gonna have to think about cash flow at some point, or. What's it all for? It's a business.
Yeah. If you keep making losses every year, that's not the kind of recipe for a successful business. But I obviously you'd know. Well, quite happy to mention names. My broker, for example, Michael Shah, who's been in this situation a lot before. Heavy cash flow investors able to sort of stack. Obviously, there's another element to that to get from where he was, say, 5 years ago to get to where he's got to now. But largely that I see a lot more in the second camp than the first camp. So then comes, and the way I kind of look at it, if I kind of look at my sort of finance background, and something I was talking to you as well in the notes as I was hurriedly putting them together for you, and I put you on the spot today, and I apologize. But something that we've done in the business, I talk a lot about portfolio construction and asset allocation. And when I've been on the show before, I've talked a lot about, the pivot, trying to bring Melbourne into the mix. And so the kind of mix of capital growth and cash flow. And so I kind of look at it from an asset allocation point of view. And I've talked about those two sort of levers to get the perfect portfolio mix. But now I wanted to bring in another sort of kind of like layer to that and talk about, what Ray Dalio does, Bridgewater Capital. So one of the smartest minds, I think, in hedge funds. If you look at the super funds, a lot of those are derivatives of the all-weather fund on what Bridgewater do. And really what that is there's an asset allocation class across how much goes into equities, how much goes into fixed income, how much goes into unlisted, et cetera. And then within those classes, within equity, you've got, kind of listed Australian equities, listed global equities, then you've got private equity, et cetera. And they're always changing. There's a lot of maths that go into the perfect mix. But what you'll see in some sort of times, if equities are overvalued, like they currently are, you'll see them start to sort of tilt, you reduce the exposure and then go to more protective type of assets like fixed income. And so you'll see those kind of weightings sort of change. So why am I talking about this? And I'm talking about this because we talked about it with capital growth and cash flow, But now I want to bring this in and just bring in some sort of tangible examples within Australia. So if we now kind of like substitute equities, we substitute fixed income, we start looking at kind of areas, not cash flow and serviceability, we can sort of maybe group a couple of like type of areas. So we've got Sydney and Melbourne. They're very quite closely correlated. Like for various reasons, they move roughly the same sort of direction in the cycle. Then you can take in the likes of, say, Brisbane, Perth, Adelaide, for example, and maybe regional, and maybe kind of stack that up. I don't want to overcomplicate it, etc. And so now if we look at it and we take in that sort of asset allocation example from Bridgewater, we're kind of like looking at, okay, we're talking off air about Brisbane before, about, to like what you can get for sort of 1.4 million. Like I think you're talking about Stafford.
It's vanishing.
1.8. It's 2-3% yields.
Yeah.
And so if you kind of look at that sort of piece of the puzzle, like, do you want to sort of like be allocating more resources and weight towards those two areas? No, because they're overvalued. And I think Perth will do well this year. I think Brisbane will do quite well. But should you really, if you've already got some sort of exposure to those areas, should you keep going there? And my kind of like thinking is no. So you'd look to those undervalued areas, and then which I believe is Sydney and Melbourne, and you could throw Canberra into the mix there. Now there's kind of idiosyncrasies about Canberra and what you can do there, and so then if you kind of then go and look in the layers, but beyond that and what you've got in Sydney and what you've got in Melbourne. Obviously, Melbourne houses are pretty cheap, but Sydney houses are pretty expensive. And so we're talking about cash flow. So you kind of break down those areas, and you have the breakdown to houses, units, and townhouses. And so now you kind of look, and I want to be a cash flow investor. I want to keep growing my portfolio. I want my next property to sort of set me up for the next one. And so then we kind of look, well, okay, there's actually, there's quite a lot of value in Sydney units, and they're pretty affordable as well. And so then you kind of look at the example I've talked about with Bridgewater, et cetera, and kind of how you can sort of change your exposure. Now you want to go to those sort of areas where there's value, where there's cash flow, and that's kind of, you're looking at Sydney units, Melbourne units potentially, and then you can stack them on top of each other. Equally, I still believe in the Melbourne house play. I think there's good examples, and with everything we talked about and what we're seeing on the ground at the moment is actually pretty good to start getting deals because people are spooked. And so there's quite good vendor discounting, etc. But then to keep stacking and building that portfolio and trying to get cash flow and have that sleep at night factor, which is so important about property investing, there are examples you can get in Sydney where you can get 6% yield. And we're not talking about the dodgy sort of like poorly constructed towers that are around, but boutique blocks that are built like bunkers where there is there is intrinsic value there.
Good 1960s, 70s build, that red brick ain't going anywhere.
Red double brick, reinforced concrete, built like bunkers on decent sort of plots of land. Not too many high rises around. You can pick them up sort of like sometimes like early fours, up to 500. I wouldn't go too much about that, but the deal economics make sense there. And then if we pivot to Melbourne as well, we can pick up in some bloody amazing areas like Brunswick, like Balaclava, for example, where you can pick up these really good units as well. And if you want to put that out, you can get some really decent, like roughly there about 6% yields. But if you've got more risk profile, you can go out and into areas that maybe are a little bit more less socioeconomic and pick up 7% yields.
7% yields.
7% yields. And so I think I gave the example before. If you did the Melbourne house, don't get me wrong, I think that'll do well. So let's just say you buy 750, you're buying in wherever it could be. Let's take Narrow Warren, for example, really good suburb, say 3.8% yield. Your cash flow sort of roughly on 100% lend before tax could be like 28, 29 grand. And then if you're getting the unit plays, I think this area will do very well, probably double. But again, like, tilting towards these more cash flow type assets, depending on what you can do, having a really good broker, good team, all the usual things you talk about on the pod so often, looking at what you can do. If you can stack, the way I look at it is I can stack maybe 10 units and get the same cash flow position on there. And so let's just take 450, for example. So I'll get 4.5 million exposure. And if there's value in these particular areas, it's not just going, okay, one Sydney, one Melbourne, one blah, blah. If is there value in a particular area, just keep going and going and going until there's no value anymore. And so even if that kind of, capital growth isn't the same as that narrow Warren house, for example, at 750, even if 50% you built that exposure to 4.5 million, you're way ahead of the game, and plus you're able to sleep at night, and potentially you've got the refi aspect, and you might be able to rip equity out, go again, etc. And I think they're like, when people worry about, I've missed a boat, the COVID boom, all of this stuff you've talked about is so hard now. There is actually an opportunity in front of everyone's eyes to get in now and get going. Now, people talk about stagnation and that units haven't performed well, and so they're going to underperform just going forward. I've had enough of this. Hasn't grown for 10 years. I'm going to tap out. Well, that's exactly the time you should sort of like be looking at it as an investor, or not sell at the wrong time, because generally when you've got massive periods of underperformance, that's when the outperformance comes. We saw it with Brisbane houses. Like, funny enough, and we saw it with Perth. Like, everyone with Brisbane, like, Brisbane's never going to go. It's always the time of Logan. And then finally we've had all of that pent up sort of like growth that's just come in to the house market. Then it came into the townhouse market. Now the unit market's just absolutely smashed it in Brisbane.
Mate, some of those units, I remember looking at units around Clayfield. Is it Clayfield?
Clayfield, yeah.
Down to
Good
Tenerife. Correct my numbers, but I feel like in 2020 you could pick up units like 200 in a really nice area. Now some of those units would be in the nines, probably. Like,
they are. I mean, the one I always use is Annerley. And so Annerley's 6K South. You're picking them up in 2021 at 250. Yeah. And I kind of been saying to all the clients, they're 600 now. And I thought I better go and have a check on this and make sure I'm not spooking people. It's 750.
Yeah.
So I understood.
Because these are I don't know about Annerley, because I've done drive-throughs, because like inner north, I guess, Clayfield. Would you call that like inner north?
Yeah, no, Clayfield's a nice spot.
It's a good spot,
close to some really good areas like Wooloowin and Ascot and places.
Yeah, for our non-Brisbane listeners, it's quite a higher socioeconomic area, right?
Yeah,
like it's
great school there.
A higher socioeconomic area. So these areas are bound to have that level of growth. And I took a few notes. In terms of unit performance, I think one thing we do get latched onto and anchored onto is not all units are like for like. And you said this, which is not the monstrosity of a tower, the block that will survive a nuclear blast. And they're very different.
Yes.
One, in terms of the approvals. If you're in the middle of Parramatta, it's very likely that you will see several new towers be constructed, not over your lifetime, but in the next 24 months. So there's that. So the fundamentals are still required, which is still needs to tick the economic fundamentals of supply and demand. Now, if you're in an area like a lot of Sydney, I grew up in the inner west in Ashfield, and I know you mentioned Ashfield before, but very strong unit market, because these are 1960s, 1970s, great builds. You have that flow-on effect, like you highlighted earlier, which is people are moving from more trendy in-demand areas. There's that natural flow out, which has that natural ripple effect from people who would have been buying houses are now buying townhouses. They're now buying units. You've got a proximity. It ticks the utility box. It ticks all the economic fundamentals. So not every unit's the same. Is the fundamental point there. And at the end of the day, and I liked your point, which is looking at the equities market, the difference between like a share and a bond, right? At the end of the day, a unit is a store of value. Yeah. It is a very tangible store of value in a way, and not to knock equities. I'm sure a lot of our listeners invest quite heavily in equities. Yeah. But it is fundamentally more tangible than equities. And if you're getting a strong yield off the back of it, it is still a very enviable store of value if you had spare money.
Absolutely, and even for owner-occupiers, for example, you're talking about the incentives, and you put out some good pods with Phil about about the 5% and kind of what that's done to the market. So if people do want to get onto that, and I was seeing the other day, I saw a tweet on, and someone was saying it's impossible to get on the Sydney market. Well, if you've got the 5% incentives and you can actually have delayed gratification, you can buy one of these units and put down maybe 27 grand at the moment to get it get it done. And I think that's pretty smart. If you can use those incentives to go to you, obviously we've got potentially rates coming up. So maybe it doesn't make so much sense if you're kind of putting 800, 900 down, and then you're putting yourself in financial stress. But something like here, so you've got owner-occupiers looking at this, but then investors who are kind of looking, okay, as we talked about most, as regularly throughout the last few minutes, like we're looking for this sort of return. We're looking for, opportunities that have stagnated, but in Sydney, we're seeing like 15% growth or so in the last kind of 18 months in some of these sort of areas where not all units are created equal. You don't have to go to the Parramatta Towers or whatever. In fact, that's the worst thing to do. But what we're seeing is okay with these type of units, they're affordable. It's a two-tiered market. So if you do, I don't know this off the top of my head, but off the plan, say in Parramatta, my guess is for the feasibilities to work, they've got to be priced at 900 to $1 million, I would think. Otherwise, the developers aren't going to make money. If someone's going to pull me up on that, I'm sure. But still, they're not going to be 500, 600 because the developers aren't going to be making money, in my opinion. And
some of the ones that are being resold are.
Because they've got problems. They've got a special levy of God knows how much. And someone's like, then kind of anchoring that to when they're thinking about units and thinking, I'm never going to buy a unit again. Whereas there's actually opportunities under their nose, which actually that's the type of unit you're going to be buying. If you're in Zetland or Green Square with the towers there, and they're offering 3 weeks of rent to entice people to come and rent that property, they're kind of renting at sort of 900 plus, I think, a week from when I've looked at it. Here we're talking about affordable housing and the rent's 550, 600. So it's very different who's going to be renting that. I'm not going to be looking at 900 in Green Square or wherever it is. And so there, you're, in my opinion, with the vacancy rates below 1% and what we're seeing on the ground, you're going to see some decent sort of rental growth in these sort of areas as well. You've got the refi aspect on the units as well, because they're so cheap anyway, and they do refinance very well as opposed to kind of like the ones in the towers. And then the other point is with the developers is to get a FISO to stack up, especially in some of these areas. As I said, they're going to have to be, the cost to construct is going to be about $750 a key. So to make any money, I'd say your 20% margin, they're going to have to be priced 900 plus. Like probably towards $1 million. And so those feasibilities are going to stack up in some of these areas at the moment. So they're going to get built. And so there's not going to be too much supply. I was reading the other day about Albanese. The immigration numbers are still very strong in Australia.
They've
gone back up. It's crazy. I don't know what they're doing, but we're kind of like, this is what we work with. So they're going to come into these sort of areas, and so no supply. There's only one way they're going, in my opinion, and there's an opportunity. It's just, I'm not saying like I'm pro, units or townhouses or houses or whatever. I'm just pro opportunity, and this is kind of where I'm seeing people can do quite well. They can get cash flow, they can get capital growth. We've seen it in the last 18 months in Sydney. Melbourne's very much towards the bottom of the cycle, and but it's changing very quickly. And so if people want to start out and they're like, I'm really quite nervous. I see that Melbourne's got a lot of value, but I really don't want to pay $650 in, say, Werribee, for example, with a 3.7% yield. I really just want to, just try it out. I've read about the units. To your point, they're falling apart. Well, if the savvy people can actually get these deals at the moment, and they can get into the market and do pretty well and stack these units quite quickly as well, and build the portfolio and start getting towards their goals.
Absolutely. And I don't know if this kind of counts as that black swan moment, because I mean it can go both ways. I think a lot of people look at it in terms of something that's going to be destructive and something that's going to undermine the property market. But I think that one thing that we've spoken about, but I haven't seen it on any headlines. We don't read news.com.au, but I haven't seen it on any news.com.au headlines which is those big developments. Super capital intensive, and those builders and the construction companies that back it, the developers that back it, carry a lot of debt. We're already at a point in Australia where we have record high insolvencies for builders and people in the construction industry and tradies. We already have record high insolvencies. Now, we had the interest rate a few months ago. We have an interest rate now, probably 2 more. And again, I think regardless, even if the war overseas stops tomorrow, I still think inflation is so baked in, looking at the future. So for the forecasted energy costs over the next 12 months, still forecast to go up another 24%. It's got nothing to do with oil. This is domestic production, right?
Yes.
That's still forecast to grow. Then you're going to have the ripple effect of the war. Yeah, you're going to have to bake in a few more interest rate rises. For people holding that level of debt, it will be extremely burdensome, i.e. the builders, the developers. Well, I think we are looking down the barrel of some substantial insolvencies, growth in insolvencies. I think a lot of those areas where you were expecting several thousand new properties to come online, I wouldn't be surprised if a lot of them don't end up coming through.
Yeah.
And to your point about the migration aspect, what you'll see is, I think you'll see the number of completed dwellings nosedive. Now, this isn't financial advice. This is just looking at the the data in front of you.
Yeah, 100%.
I would say the number of completed dwellings over the next 24 months are going to nosedive, and you can kind of project immigration as well with how many visa holders are applying for visas. You can essentially guess how many people are coming on a month-to-month basis before the month's even done. So for March, I think we know we're going to be at about 58,000. So when that level of demand is going to increase and our supply is going to drop off, the fundamentals are very, very clear. So when you add that to fewer people listing with CGT, when you add that to all of these things together, I still think that Australia's property market is going to be super resilient. Now, I might sound like I'm justifying it, but the numbers on a page don't lie.
No, it's hard. I mean, we're on a property investing program, and you do need to be objective about what's going on. And we've seen. I talked to this with my wife a little bit, and she tells me what goes. She's Chinese. We see what's going on in China. It's very, very different to what's going on in Australia. We've sseen prices come down in New Zealand, for example. But it is very different here. And I was reading an article the other day about Brizzy, about saying like because there's so much population growth in Brizzy and southeast Queensland recently, and how they're like the way it's going, there's going to be no more units for sale in the next month or so. And so
it's true. Brisbane's the most expensive city for first home buyers.
Yeah,
I saw the headline. I'm like, how does that make sense?
How does it make sense?
And then it's because they've got no quote unquote affordable construction that's going on.
Yeah.
So whereas if you're in Sydney, you can buy a unit, you don't have that level of option in Brisbane, which actually reflexively goes to your point that the Brisbane unit market has outperformed so well that now it's deemed less affordable than Sydney.
Yeah, I mean, houses outperformed in Brizzy for quite a long period between 2019 and 2022, 23, some of the best assets you could have bought anywhere in the country. But now units since 21 to sort of 20, till the recent 5% incentives where it sent the house market up to another level, did outperform for a period. And so we've got that sort of precedent that's already happened. We've seen it a little bit in Perth as well, with the yields around 8% at one point, and seeing units grow there. But here, I totally agree with you. Immigrants coming in, where they're going to go? They're going to go to Sydney. They're going to go to Melbourne. They have been going to Brizzy as well. But still, like, what are they going to do? They're going to rent in affordable areas. They're going to rent where kind of sort of people they grow up with are, or whatever, people migrating through, and they're just going to try and get the cheapest places that they can find. And once they what we do see is once they are settled in a sort of area, they do generally tend to buy. So with kind of like, it's a really good point you made, and I don't think it's the wrong thing to talk about, because we've seen a lot of builder insolvencies that have happened over the last few years, especially with materials coming up and everything. What's going on in the Middle East is going to get harder and harder, and so I think you're spot on. I think we're going to see a lot of these projects get canned just get canned, and then it's just there's not going to be the supply. I didn't really realize that number in March was around 50,000. That is incredible.
Yeah, we're still on track for like a 600,000 plus
600,000
12 months year. Yeah, so, and the other consideration here in the supply demand curve is that a lot of it's still PPOR led.
Yeah,
a lot of it's still PPOR led. We've been talking about Perth as investors for ages, but I speak to agents over there, and anecdotally, they're like, "Mate, it's owner-occupier driven demand," which actually is a very good thing. That's a very
that is
good,
great. That's healthy.
That's exactly it. It's the sign of health of a market. At the end of the day, you don't want to be buying into a market where every other house is owned by an investor, and the second there's an economic blip, you all sell at the same time. No,
Yeah.
I mean, it's the value of the house is only going to be really as good as the value of the people that want to own, but live there primarily. So when you're looking at Perth and you're like, well, the average days on market's like 8 days or 9 days or something,
crazy. Yeah.
primarily led by owner occupiers. And I've got agents out there that are telling me it's like, like I list something and I'll have 10 couples put in for contract the same day. Like it is supply demand, because there just isn't the dwellings coming on that can satiate this market. That is as a result of things like the 5% deposit scheme or first home buyers grants or what is it, the shared equity scheme? What's that called? The home guarantee scheme or something where the government will take up to 40% equity in your house. This is a super liquid market. Like as much as we talk about housing unaffordability, and I do think houses are unaffordable for a lot of people, it is for a lot of people, but it's still also affordable for a lot of people, and that's why there is still demand.
No, there is, and I think the Perth example you give is great. I think they've got record number of listings. I think it's about 2,000 or so, only 2,000 properties for sale on the market there.
They're record low.
It's never been this low before, and all the points that you sort of talked about kind of make sense. And so owner occupiers driving that market. If you've got a few sort of properties in Perth, you're laughing. Now, the thing I to think about as an investor when I look at Perth, like obviously it's a good momentum play, but do I really want to be going in there at the moment because the deal economics all of a sudden don't make sense? It's the same as what we were talking about in Brizzy, for example. Like I think Brisbane will be still resilient. But again, if I'm going and buying in some of the areas I was buying, let's just take Naranda, for example. Like when I bought there, it was about a 4.5% yield, which I actually took a lower yield at that particular time, but I wanted to get into a better area. But now to sort of get into that area, I think we're looking at 2 to 3% yield to for a house on 600-700 square meters of land. And even if you look down in Mandurah and those type of places, they're going gangbusters or whatever, but the properties you're buying at sort of 200-300 are now sort of 600-700. And so and they're probably renting probably a 4%, 4.5% yield. But I just, for me, I certainly see why people are doing it. But for me, I think there's better options out there. There's going to be decent capital growth for sure, but then to get the cash flow, I think there's better opportunities out there. But I think it's always fun to sort of deconstruct what's going out there in the markets.
So with all of this, it's funny just like taking stock of this podcast, and we've kind of not swung wildly. That's not a great way of putting it, but we've acknowledged that, hey, there are kind of potential dark clouds on the horizon. Yeah. It doesn't mean that I don't see any reason to panic. I see no reason to panic. I think it's time to just have a rethink. I started off the podcast by saying this as well. If you do have an interest rate increase of 25 basis points, and then a property now, your repayments on a property go up $120 a month, that is quite minimal. And if you're relying on $120 a month for your profitability, then I'll tell you what, all it takes is one stove to break, one light fitting to smash, or like a window to go out, and you'd be in the red anyway. Realistically, a lot of this is the cost of doing business. We're still not actually at a point where we're higher in terms of interest rates. Our interest rates are not higher than that COVID high. Like the post-COVID high, right? Like 4.1 is where it capped off. We're kind of where we were last year.
Yeah, I think roughly when you look at history, we're kind of still pretty low. Historically where we are. So there's definitely room to go out. But I think to you, and I guess you're gonna love this pun, but it's a smart property investment show. So we were talking about smart property investing. There's good opportunity still there with some clouds on the horizon. You just gotta be it's smarter to give it that sort of pun there in what you're doing. You can't just throw the dart at the dartboard if you're not looking at the deal economics and what you're doing, and looking at kind of where a market is in the cycle, looking at kind of what you've got in your portfolio, and then just thinking, it'll be all right. We'll just we'll throw another one to Bundaberg or wherever it might be, because Mackay and Townsville have done so well over the last few years. I think you need to be a lot more strategic, and you need to sort of be cognizant that while rates are rising, there's a bit of pain. They're still pretty low, and they could go a lot more. And so with that mind, I think I'd certainly would rather be with assets rather than without assets, and I still want to keep growing portfolio and building it. So you want to go a little bit more protective in the portfolio, and you'll still do well. We want those kind of products that are going to be almost a hedge to inflation, if you will, which I believe the units are at the moment, because where they are still, like, no matter what's happening with inflation, etc., they're affordable to the local population. Almost everyone who's here can afford to get onto the areas that we've just talked about. And so rather than sort of I know we're jumping around all over the place, but I was looking at prices in the Gold Coast for houses the other day, and the Gold Coast is going off. There's people everywhere there. But it's hard to get houses under 3 million. Yeah. And so when I talk about hedge to inflation, I mean, there's only a handful of people who can afford to buy those. So are they going to have headwinds? Well, potentially yes.
Maybe, yeah.
And so these type of assets, these cash flow assets we're talking about, are very, very safe in potentially uncertain times, and there's still opportunities to get ahead and build wealth for your family.
And I mean, with this, a lot of those suburbs that we were talking about before, for say the unit play, are remarkably commutable. So if you look at, I know we didn't give any examples in Sydney, but I kind of think around Auburn, Lidcombe, areas like that where you can still get pretty affordable units. I mean, we're talking about 25 minutes on the train to the city. Like, it is ultimately commutable. Now, it's not necessarily. I've got to pick my words carefully. It's not a Bellevue Hill. No, it's not a Paddington. But at the end of the day, if you're in an ultimately very commutable area, which has a lot of local demand, in so much as you have a very vibrant local community that wants to stay within their local community, and I'm looking in particular about multicultural communities, and the utility they get by living closer to their family, friends, their community groups, their cultural groups. You're always going to have that kind of domestic demand for that area, for people from that area. It's not a commuter hub. Yeah. It's not like those new build suburbs that didn't exist 3 or 4 years ago that came very quickly and could leave just as quickly as well. Yeah. So with that, it is. To your point before about balancing the equities with the fixed income kind of bonds, it is a bond play.
Yeah, that's a very good way of putting it. It is. And if you take that Auburn property, and everyone's talking about cash flow, I'll give you an example of something we did buy recently. I don't usually sort of plug the sort of buyer's agency, but we did pick up a 2-bed, 1-bathroom in Auburn, and we picked that up for $435. $435, 10,000 rented for $600 a week. Rent in the first week, multiple applications. This was in December, but we did pick up one. We picked up 4 this week actually, and there's one at the moment again in Auburn, $460. We picked another one up $450 2 days ago in Auburn. We picked one up in Punchbowl, $480. And so there are opportunities out there. So
what's the maths on that? Like for the $430, $600 rent, like that's
a 7.19% yield.
Wow.
Yeah, I know. I mean, shout out to Scotty who bought that one.
Wow.
But yeah, I mean, he killed it on that particular one, and now we can just sit and forget.
So, well, I mean, I don't know if you can go into the nuts and bolts of the portfolio, but at what point, factoring stamp duty, factoring in
yeah,
at what point? So, how much deposit would that be? Positively geared, you probably only need like a 15% deposit. It'll be probably positively geared.
Yeah. Obviously, you did this on 100% lend, used a bit of equity to sort of go there, but roughly the numbers are on 100% lend. I think it was 4,000 negative on 6.5% rate on 100%, and then after tax about sort of 2,300, and there will be sort of rental growth in that opinion
over a year.
Yeah, over a year. So
what? So with a 100% borrow?
Yeah, 100% borrows. Yeah, it would be before tax about 4,000 negative.
Yeah,
on the year, and then after tax about 2,300. And we're talking about Auburn in Sydney. And another shout out, my old boss at ART, Norm, lives in Auburn, has a house there. And so we're talking, and he's a very high up sort of individual at Australian Retirement Trust. It's and we're buying units at kind of a fraction of the cost, and that's something we do look at. We look at kind of roughly what the house prices are going to be as opposed to sort of like the unit prices. So Sydney's trading at a 50%, or the units in Sydney are trading at 58% discount to houses. But if you go out to some of these areas, it's sometimes 75%. And so when we looked at sort of Punchbowl and Campsie, but let's take Punchbowl for example, where we bought a house, so there was a unit I should say, it was 465 this week. There's a house being constructed on the other side, 2.5 to 3 mil, and and it's like, I mean, it's one of those little. Everyone talks a lot about data and stuff, and obviously there's a place we've got to look at data themes, etc. But sometimes just pounding the pavements and actually looking at what's going on. So everyone kind of turns their nose up at, say, a Punchbowl or wherever they are, but you go and look on those streets and you look at the houses and you see people driving Mercs, people driving Beamers, etc. And that's generally a bit of a kind of hat tip. This area is changing a little bit, etc. And so that they are out there, you can still get those cheapies and get good yields. And then Melbourne, like the kind of like the scenario. And again, I'm happy to talk areas, but you know, Footscray has got quite a lot of obviously stock, and potentially it'd be interesting if they get those across the line. But sometimes you're picking those up at, say, early 300s, renting for $450 a week.
And what's the maths on that?
Oh God, you've asked me the question.
Yeah, I know. You should have known.
I shouldn't have. I think it's about 7.2.
Wow,
about 7.2, and so we did pick three of those up in Footscray a couple of weeks ago, but then. As I said, we were one in Brunswick, 390,000, renting for $520 a week.
Yeah,
I mean, they're everywhere.
I'm not going to ask you again. I think I pushed the. You're coming out with the numbers quick.
I'm open with everything, but they're all recent deals, and so we bought so many out there, and I know kind of like the team are going to be, shut up, Steve, don't. But if it helps someone, if someone's thinking, how do I go, and you know they're seeing that. People are buying X amount in Townsville, X amount in Melbourne at the moment, and then we talked about Stafford at God knows how much. Like, you can go out there and do this and get some pretty decent equity. But even if you, like, when I capital growth, but also when I say equity, a good refinance on these type of things. And I think sometimes people miss that, whereby the bank values are going to be extremely positive on these assets, and you can rip equity out and go again, especially with CBA, etc. So. Good broker there can help you sort of with this, and you can stack those properties on an okay sort of income. It's not as if you've got to,
even if you're a super risk averse investor, right? You know, if you're 2,500 in the red after a year, which is absurdly little, right? And this is what we're talking about before. You know, there's a cost of doing business. Which is a very reasonable cost of doing business. If you came in armed with a 15-20% deposit to just, you know, rid yourself of LMI, it is very easy to see how you can, if as a very risk-averse investor, that you could pay this asset off in a very fast manner.
Well, yeah, I mean, absolutely you could, and or you can just keep extracting equity, keep going. But I'm going to tell you exactly what I'm going to be doing for my self-managed super fund. So I've got two assets in there. I've got a duplex in Goodna and Ipswich. That's staying where it is. We've got a house in Perth and in Mandurah. And so this is kind of my mindset. I'm not saying I'm right and everyone's wrong, but obviously with self-managed super fund, you can't extract equity, but you can sort of trade that in and sort of like take 10% capital gains on that. So this one in Perth is in Mandurah. It's in Dudley Park. Picked it up for 410. It's probably worth about 700 now. We paid that down a little bit. And so the way I kind of look at it is, okay, going back to this kind of like, you know, looking at the portfolio construction, I think Perth, there's probably a little bit more in that market. It'll probably go up a little bit. But I think, okay, let's cash that in now. We'll realize about sort of like, you know, because obviously we put 30% into that one. So we've got a lot of cash in there anyway. So we'll realize quite a lot of cash back from that particular one. And I'm just going to go unit. And obviously, to your point, we're putting 20% into each one of that. So let's just say they're roughly 500,000 each, 1.5. The Goodna one's like 1.2, so 2.7 million in that one. They're all going to be yielding basically neutral as they are to start with.
And they'll grow up over time. That's the inflation busting aspect that you're talking about.
100% it is. It's not financial advice. I'm just talking about what I'm doing for my own portfolio. So I'll just take the highest yielding unit in that particular portfolio, put the contributions, pay that down, and then you've got like the rent from that particular one plus my own contributions to smash the next one down, then the next one, And then we're quite close to that 3 million sort of threshold. So in this SMSF, but luckily I'm married, so my wife's in there as well.
Yep.
And so we've got another 3 mil with her. So there's potentially 6 million anyway in the self-managed super fund.
Yeah.
Potentially before we hit the unrealized gains, etc. And so it can be a powerful strategy in your self-managed super fund as well.
That is some fantastic advice. That's not financial advice.
That's not financial advice. I have no idea what
insights. Now, Steve, I'm sure we've inspired people today. We've inspired people. I know you've got your own podcast. People should go on, listen to Steve's podcast. It's absolutely fantastic. How can people watch your videos? How can people reach out?
Well, I'm trying to take notes from Liam here to become a better presenter. So our own podcast is called My Next Property.
Yep.
And kind of like the idea was to talk more hotspots, etc., what people can do now. And so, please go and have a look. Obviously, the company's propertystrats.com.au. Just flick us an email. One of the team will be in touch. But really, I just, again, I love coming on this show. I love coming and just showing what can be done. But action steps, sort of like, I hope if someone is inspired by this, again, find a good broker. Like, you have some cracking brokers come on the pod. One who we're kind of talking to tomorrow, Hung Choi. So looking forward to that particular one. See what you can do. Sort of, if you've maxed out your own portfolio, you've got the SMSF. I always say with SMSF though, with great power comes great responsibility. And so make sure you do the right thing there. You don't go and play house and land in the middle of nowhere. You talk strategically with your team, your buyer's agent, your accountant, your broker. Make sure you do the right thing there. But there's a clear sort of number of action steps that people can take. Talk to the team, look at what they can do, where the next purchase is. You might be maxed out in your main portfolio, so there's other steps, but go and do something. Like, it's a scary time. We've talked a bit of doom and gloom on this, but you have to be cognizant of this as an investor. Yeah. But with that, there's opportunities that arise. So
without a doubt.
I hope you got it. It's great for you to have me on. I'm hoping to get to your skills on my own sort of podcast.
No, I'm learning from you. I've got to be far quicker at maths and have that level of financial insights on advice.
I'm sure someone's going to pull my maths to pieces.
More or less. Okay, details. Steve, thank you so much for joining us today.
Pleasure. Thanks, Liam.
And that was Steve Ash from Property Strats. And if you do want to reach out to Steve, make sure you reach out to him on his website, but also go on Instagram, watch some of his videos, his new podcast. It is absolutely fantastic. And that is all we have time for today on the Smart Property Investment Show. And until next time, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.